I learned early that the market does not reward activity, it rewards judgment. A man can sit at a desk all day and make nothing but commissions for his broker, or he can wait and make one decision that matters. Time of day, you see, is not about the clock on the wall. It's about the condition of the market. Still, you and I both know the clock has a way of tempting us, doesn't it? When the bell rings and prices begin to move, doesn't the urge to act come rushing in? Most beginners believe the best trading happens the moment the market opens. Prices jump, volume pours in, and everything looks alive. But liveliness is not the same as opportunity. In my experience, the opening is when emotion speaks the loudest. Overnight opinions collide, orders pile up, and the tape runs fast. Do you really want to make your most important decisions when the market itself is still clearing its throat? I've always said that the market is never wrong, but opinions often are. Early in the day, opinions dominate. Traders rush to act on news, on rumors, on what they think should happen. The tape hasn't yet revealed what is happening. I learned to watch first. I let the market show its hand. If a stock is truly strong, it will still be strong after the early noise fades. Isn't patience the hardest discipline to master? As the morning progresses, something changes. The weak hands finish their business. The professionals begin to show themselves, not with excitement, but with persistence. Trends start to behave like trends. This is when time becomes an ally instead of an enemy. A stock that holds its gains after the early selling tells you more than a dozen headlines ever could. When price and volume agree, the market is speaking plainly. Are you listening, or are you still trying to predict? The middle part of the day has a poor reputation, and in many cases it deserves it. Volume dries up, prices drift. Nothing seems to happen. But nothing happening can be information if you know how to read it. A strong stock that refuses to fall during a quiet market is showing character. A weak one that cannot rally without volume is confessing its weakness. Do you see how silence can be as revealing as noise? I never made my money by forcing trades during dull hours. I made it by observing how price behaved when nothing pushed it. This taught me restraint. Restraint builds capital faster than excitement ever will. A trader who must always be in the market is a trader who will always be paying tuition. The market does not charge by the hour, but it does charge for impatience. Haven't you paid the bill before? As the afternoon approaches, the market begins to prepare for judgment. Institutions adjust positions. Large operators reveal their intentions quietly. This is where the day's true direction often becomes clear. If a stock advances steadily into the close, it suggests confidence. If it fades when it should be strong, it tells another story. I found that trades aligned with this late day clarity had a better chance of following through. Doesn't it make sense to trade when the market itself seems more certain? The close is not about drama, it is about commitment. Prices at the end of the day reflect decisions traders are willing to carry overnight. That is serious money talking. When I saw a stock closing near its highs after a constructive day, I paid attention. Not because it promised easy profits, but because it showed agreement between time and price. The market had spoken, and it spoke calmly. But let me tell you this plainly, there is no magic hour. Anyone selling you that idea is selling hope, not understanding. The best time to trade is when your method aligns with the market's condition and your own state of mind. A tired trader sees ghosts. An anxious trader sees opportunities that aren't there. Discipline begins with knowing when not to trade. Do you know when to stand aside? Your mindset matters as much as the clock. If you approach the market trying to squeeze money out of every tick, you will fail. If you wait for your opportunity, one that fits your rules, your risk, and the market's rhythm, you give yourself a fighting chance. Wealth in trading is built not by constant action, but by consistent behavior. That behavior is shaped by respect for time, price, and yourself. I always believed that successful speculation was a campaign, not a battle. You choose when to engage, and you choose when to rest. The market will open again tomorrow. Opportunities will return. Missing a trade costs nothing. Taking a bad one costs confidence, and confidence is expensive to rebuild. Isn't protecting your mental capital just as important as protecting your money? So when you ask about the best time of day to trade, I answer this way: trade when the market confirms your thinking, not when your thinking tries to command the market. Watch how price behaves after the excitement, during the quiet, and into the close. Time will show you which moves are real and which are just noise. And if you learn to wait for those moments, the clock will stop being something you chase and start becoming something you understand. Real strength survives the first hour's noise, and I learned that lesson by losing money before I ever made any. The opening hour is when excitement dresses itself up as opportunity. Prices jump, volume swells, and every move looks important. But tell me this, since when did importance equal truth? The market opens like a crowded auction, everyone shouting at once, and very few listening. If you trade in that noise, you're not reading the market, you're reacting to it. In that first hour, weak hands are busy proving they don't belong. They rush to buy because they're afraid of missing something, or they rush to sell because they're afraid of losing something. Fear and hope take turns driving the tape. I've seen strong stocks dip sharply in that hour, not because anything changed, but because impatient traders demanded immediate confirmation. If a stock is truly strong, it doesn't need applause at the open. It can take a punch and keep its balance. Have you ever noticed how the best stocks don't beg for attention? What you're really watching in the first hour is a test. Not a test of speed, but a test of character. Can a stock hold its ground when sellers show up early? Can it recover without drama? Can it trade heavy volume without collapsing? These answers don't appear in the first few minutes. They appear after the market has had time to breathe. A stock that shakes off early selling and begins to firm up is telling you something important. The question is whether you're patient enough to hear it. Most traders think strength looks like immediate upward movement. That's a beginner's definition. Real strength often looks dull at first. It looks like refusal. Refusal to go down when it should. Refusal to follow the crowd. Refusal to panic. When I see a stock dip early and then stop declining, I pay attention. When I see buyers quietly absorb shares instead of chasing them, I take notice. Isn't quiet confidence more trustworthy than loud excitement? The market doesn't reward those who are first. It rewards those who are right. And being right usually means waiting until the early confusion sorts itself out. The first hour is full of false signals because it's full of unfinished business from the day before. Overnight orders, delayed reactions, second thoughts, all of it spills into the open. You wouldn't judge a man's character in the middle of a crowd shouting at him. So why judge a stock before the market settles? I made it a rule never to trust a stock solely because it was strong in the opening minutes. I wanted to see how it behaved after the excitement wore off. Did it hold above key price levels? Did volume contract on pullbacks? Did it attract buyers without needing headlines? These things take time to show themselves, and time in trading is a filter. It removes the reckless and leaves the deliberate. Are you willing to let that filter do its work? There's also something else at play, the trader's own mindset. The first hour tempts you to prove something, to be active, to feel involved. But trading is not a performance. No one gives medals for early entries. If you feel pressure to act simply because the market is open, that pressure is not coming from the market. It's coming from you, and acting on internal pressure is one of the fastest ways to separate yourself from your money. When real strength appears, it doesn't disappear just because an hour has passed. Strong stocks don't rely on timing tricks. They rely on demand. Demand from operators who aren't interested in quick moves, but in sustained ones. Those operators don't chase the open. They wait. They test. They let others exhaust themselves. And when they move with purpose. Wouldn't it make sense to trade alongside that kind of thinking instead of against it? The trader who learns to wait through the first hour gains more than better entries. He gains clarity. He sees which moves were emotional and which were intentional. He sees which stocks needed the market's excitement to move and which ones stood firm on their own. That clarity builds confidence, not the fragile kind that comes from a lucky trade, but the steady kind that comes from understanding. I never believed in fighting the market's natural rhythm. Morning is for observation. Let the market show you what it values after the noise fades. Let price and volume settle into something honest. When a stock survives the first hour without losing its structure, without breaking its tone, without attracting frantic selling, it has passed an important test. That doesn't mean you must trade it immediately. It means you've identified a candidate worthy of attention, and attention, properly directed, is one of a trader's greatest assets. The market offers endless movement, but very few meaningful opportunities. Learning to ignore the opening chaos sharpens your focus for the rest of the day. You stop chasing and start selecting. You stop reacting and start interpreting. And once you understand that real strength doesn't need the first hour to prove itself. Waiting is a position, and often the best one, though most traders refuse to believe it. They think if they are not buying or selling, they are wasting time. But the market does not pay for effort, it pays for judgment. I learned that the hard way, by trading too often and thinking too little. Every unnecessary trade taught me the same lesson: action without reason is just disguised impatience. Have you ever noticed how the urge to trade grows strongest when nothing is actually lining up? Waiting is uncomfortable because it forces you to confront yourself. When you are not in a trade, there is no market to blame, no position to defend. There is only you, your rules, and your discipline. Many traders would rather lose money than sit still, because sitting still exposes uncertainty. But uncertainty is not danger. Acting without clarity is. The market will always offer movement, but movement alone is meaningless. What matters is alignment, price, volume, time, and your own state of mind coming together. I used to think I was missing opportunities by waiting. In truth, I was avoiding mistakes. The market opens, prices fluctuate, stories form, and suddenly everything looks urgent. That urgency is false. Real opportunities do not rush you. They wait to be recognized. A proper setup looks the same whether you see it at once or after an hour of observation. If it disappears the moment you hesitate, it was never meant for you. Isn't it strange how the best trades don't need persuasion? Waiting protects capital, and capital is a trader's lifeblood. You can recover from a missed trade, but you cannot recover easily from a series of careless ones. Every trade carries risk, and risk should be spent only when the odds justify it. By waiting, you preserve not just money, but confidence. Confidence grows when you know you acted by choice, not by pressure. And pressure, in trading, is usually self-inflicted. There were days when I watched the market from open to close without making a single trade. At first, that felt like failure. Later, I understood it as discipline. The market did not owe me a profit simply because I showed up. My job was not to trade every day, but to trade well when the conditions were right. Waiting kept me from forcing ideas onto the market. It reminded me that my opinion meant nothing unless price agreed. The impatient trader sees waiting as lost time. The experienced trader sees it as preparation. While waiting, you observe which stocks behave properly and which ones fall apart under pressure. You see how volume enters and exits. You learn the market's tone. This information costs nothing, but it is invaluable. When the time comes to act, you are no longer guessing. You are responding. Would you rather act with information or with hope? Waiting also trains the mind. It weakens the habit of overtrading, which is one of the most expensive habits a trader can have. Overtrading comes from the belief that more trades mean more opportunity. In reality, more trades usually mean more exposure to randomness. The market has long stretches where it offers nothing but temptation. Waiting helps you recognize those stretches and avoid them. You don't need to prove anything to the market. The market doesn't keep score that way. There is a psychological strength in knowing you can walk away. When you are not desperate to be in a trade, you negotiate from a position of strength. You wait for the market to come to your price, your setup, your rules. This mindset shifts trading from chasing to selecting. Selection is what separates speculation from gambling. The gambler needs action. The speculator needs confirmation. Many traders confuse waiting with fear. They think standing aside means lacking courage. In truth, it takes more courage to do nothing than to do something foolish. Waiting requires trust in your method and respect for the market's timing. You are not avoiding risk, you are choosing when to accept it. That choice is the essence of professionalism. Have you ever noticed how the market punishes those who try to control it, but rewards those who adapt to it? Waiting is not passive. It is active observation. You are reading the tape, noting behavior, watching reactions. You are preparing for the moment when the market reveals itself clearly enough to act without forcing. When that moment arrives, the trade feels almost obvious. There is less internal debate, less emotional noise. That clarity comes from waiting, not from rushing. I came to understand that my greatest profits were not made by constant activity, but by a handful of well-timed decisions. Those decisions were only possible because I spent long periods doing nothing. Afternoon trading reflects professional intent, and that is something you only learn by watching long enough to separate amateurs from operators. By the time midday has passed, most of the emotional business has already been done. The excited buyers have chased, the nervous sellers have panicked, and the market has absorbed a good deal of weak opinion. What remains is quieter, more deliberate, and far more meaningful. This is the part of the day where the market stops reacting and starts deciding. Have you noticed how the tape seems calmer, yet more purposeful? In the afternoon, price movements tend to lose their drama. Moves become steadier, less frantic. That doesn't mean opportunity disappears, it means opportunity becomes selective. Professionals do not need speed to make money. They need alignment. They wait for the market to show its direction, then they act without haste. When you see a stock grinding higher late in the day without excitement, that is often not the public at work. That is intent revealing itself quietly. I learned to respect the afternoon because it exposed false strength and confirmed real strength. A stock that could only rise in the morning often struggled later, but a stock that held its gains and continued to attract demand as the day wore on was telling a different story. Afternoon buying is not impulsive. It is considered. Those traders are thinking beyond the next few minutes. They are willing to hold risk overnight. Doesn't that say more than a quick spike at the open? By afternoon, the market has processed the news. Reactions have already happened. What you see now is not surprise, but judgment. Large traders are adjusting positions, not chasing headlines. They are looking at structure, at levels, at how price behaved earlier. When they commit in the afternoon, they are doing so with information, not emotion. That distinction is everything in speculation. Many traders are exhausted by afternoon. They've traded too much in the morning and given back energy along with capital. Their focus weakens. This is why the afternoon belongs to the prepared. If you conserved your attention earlier, you can now observe clearly. You see which stocks refuse to give up ground. You see where volume returns with purpose. You see which moves are supported and which ones drift aimlessly. Observation sharpens when fatigue is absent. Afternoon trading also teaches patience within a trade. Moves are rarely explosive. They unfold slowly, testing conviction. A stock may pause, pull back slightly, then resume. This behavior scares impatient traders, but it reassures professionals. It shows controlled activity. It shows that buyers are not in a hurry and sellers are not in control. The market is negotiating, not arguing. Would you rather trade in a shouting match or a calm discussion? One of the most important lessons I learned was that late-day price action often reveals tomorrow's possibilities. The close reflects decisions traders are willing to carry forward. Afternoon strength that holds into the close is rarely accidental. It is a statement, not a promise, but a statement of interest. Professionals understand that price paid late in the day matters more than price paid early, because it reflects conviction after the facts are known. This is also where discipline separates traders. Afternoon opportunities are fewer, which tempts people to lower standards. That is a mistake. Fewer opportunities demand higher selectivity, not less. When you wait all day and finally see something setting up, the temptation is to force it. But professionals do not act because they waited long. They act because conditions align. Waiting does not entitle you to a trade. It prepares you for one. Afternoon trading rewards those who respect risk. Stops tend to be clearer. Levels have been tested. Volatility has settled. This allows for better judgment. Not safer trades, but more understandable ones. Understanding reduces emotional interference. When you know why you are in a trade and why you will exit, fear has less room to operate. And fear is the enemy of execution. I found that my best trades often began quietly in the afternoon. No excitement. No rush. Just a stock behaving properly when it should have failed. Those trades did not feel thrilling. They felt reasonable. Reasonable trades rarely make good stories, but they often make good results. The market does not reward drama. It rewards consistency. There is also something important happening internally during the afternoon. Your own mindset is tested. Can you remain patient after a slow day? Can you stay objective when the clock is running out? Many traders feel pressured by time, as if the day must end with a trade. Professionals do not think that way. They understand that the market does not reset your account at the close. Tomorrow exists. Afternoon trading reflects maturity, both in the market and in the trader. It requires letting go of the need for constant stimulation. It requires trusting observation over impulse. When you align yourself with that mindset, you begin to see the market differently. Not as something to conquer, but as something to read. The afternoon does not shout opportunities, it whispers them. And when you learn to hear those whispers, you stop chasing morning excitement and start recognizing late-day intention. You notice how certain stocks tighten instead of breaking, how volume creeps in without announcement, how price respects levels it ignored earlier, and how the market itself seems to slow just enough to let you see what it was trying to say all along. If you were willing to wait and watch and stay focused, while others grew tired and distracted and began to act for reasons that had nothing to do with structure, price behavior, or professional judgment. Discipline decides when to trade, not the clock, and that idea took me longer to learn than any chart pattern or rule I ever studied. The clock is a convenient excuse. It gives a man something outside himself to blame. It was too early, he says, or I had to act before the close. But the market does not recognize excuses, and it does not recognize time in the way people do. It recognizes behavior, and behavior is governed by discipline, or the lack of it. Have you noticed how two traders can look at the same market at the same hour and do completely different things? I used to believe that certain hours demanded action. I thought opportunity lived inside fixed windows, and if I missed them, the day was wasted. That belief cost me money. It pushed me into trades that did not meet my standards, simply because the hands on the clock were moving. Discipline corrected that thinking. Discipline taught me that no hour owes me a trade. The market offers chances when it chooses, not when I demand them. My job was to be ready, not rushed. A disciplined trader does not ask, "What time is it?" He asks, "What is the market doing?" Those are very different questions. One looks outward at a schedule. The other looks inward at judgment. Discipline is the ability to wait without growing restless, to observe without interfering, and to act only when conditions align. That alignment is rare. If it were common, trading would be easy, and it isn't. Isn't it interesting how the hardest part of trading is usually doing nothing? The clock pressures you into thinking that opportunity is scarce. Discipline reminds you that opportunity is selective. The market moves every minute, but meaningful opportunities do not. They appear when price, volume, and structure come together in a way that limits risk and clarifies intent. If those elements are absent, the time of day is irrelevant. Trading without discipline is like driving faster because the road is empty, ignoring the fact that you don't know where the turn is. Discipline also protects you from yourself. Most bad trades are not caused by bad analysis, but by emotional timing. You trade because you are bored, or frustrated, or eager to recover a loss. The clock becomes a trigger. I've been watching all morning. You tell yourself, "I need to do something." Discipline answers back, "No, you don't." That internal conversation determines whether you survive in this business. I learned that discipline is not a single decision. It is a habit. You practice it every day by refusing trades that do not meet your criteria, regardless of how tempting the movement looks. You practice it by accepting that some days will pass without action. You practice it by ending the day flat when nothing made sense. Over time, discipline reshapes how you see the market. You stop seeing motion as opportunity and start seeing structure as invitation. There is a difference between being available to trade and being obligated to trade. The clock creates obligation. Discipline creates availability. When you are disciplined, you are ready at any hour, but dependent on none. You can trade the open, the afternoon, or not at all, because your decision comes from conditions, not from time pressure. That freedom is one of the greatest advantages a trader can have. Many traders try to compensate for lack of discipline with rules about time. They say they only trade certain hours, hoping structure will replace judgment. Time filters can help, but they are not discipline. Discipline is internal. It is the willingness to follow your rules, even when no one is watching and nothing is happening. It is the strength to stay consistent when the market is inconsistent. Without that, no time window will save you. Discipline also shapes risk. When you trade because the clock says you should, you accept risk blindly. When you trade because your setup demands it, you accept risk knowingly. That difference affects execution, position size, and emotional control. A disciplined trade has a reason to exist. An undisciplined trade exists because something had to fill the time. Which one do you think survives pressure? I noticed that disciplined traders speak less about hours and more about behavior. They talk about how price reacted, how volume confirmed or failed, how the market responded to support and resistance. Time is only mentioned as context, never as justification. That mindset keeps them aligned with reality. The market does not care if it is morning or afternoon. It cares whether buyers or sellers are in control. Discipline is also what allows you to stop. Knowing when not to trade is as important as knowing when to trade. The clock will always tempt you to keep going. Discipline tells you when your edge is gone, when your focus is slipping, when the market has changed character. Walking away at the right moment preserves capital and confidence. Both are necessary for longevity. Over time, discipline turns trading into a process instead of a reaction. You stop chasing moves and start waiting for confirmation. You stop blaming timing and start evaluating decisions. You accept responsibility for every trade you take and every trade you skip. That responsibility sharpens judgment. Judgment, sharpened by discipline, becomes your real edge. And once discipline takes control, the clock loses its power over you. The urgency fades, the noise quiets, and you begin to see the market not as a sequence of hours demanding action, but as a living structure that reveals itself only when you are calm enough, patient enough, and disciplined enough to respond rather than react, to wait rather than chase, and to understand that the decision to trade is never about what time it is, but about whether the market, in that moment, has truly earned your participation.